Hello traders and investors, this is Sal for Expo Futures here with another educational video for you. We'll be covering the gold market primarily because it made such a large move and it's time to give you an update on the gold. We'll be using this video on gold also to update you on credit spreads. If you're not too familiar with credit spreads, which is a credit vertical spread, this is a good video for that as well. We have here this gold which went into that 1270 range. I'm rounding up from the current overnight price. This is overnight trading now, but a big move, new closing highs on the gold. 1270 is going to be a valid number here. Asking around, our chief market strategist Armand Badatigna has chosen a target potentially of 1350 to 1360. Okay, so we'll 1350, 1360. That's around there. How we get there could be a different story, right? So that's probably quite a bullish number on the gold, 1350. You also have the other side. Where does it pull back? Could pull back anywhere between this 1250 range to 1200. And even 1160, but the normal retracement would be this cluster to 1200. Pointing out those levels will help us find out what strikes are good risk parameters for an option trade. The other thing I want to point out is here's a CBOE chart of gold volatility. Before you put on an options trade, it's good to check in on the volatility of those options. You want to know if they're relatively expensive or relatively cheap based on the volatility, which tracks the premium at the money strikes. Generally what you'll see is when there's more fear and panic in the market, like after the flash crash, there's more premium across the board in all contracts because of uncertainty, and that's what this big spike is showing. And when the markets are more sideways or calm and there's not a lot of volatility or movement, they're at lower levels. And that's where we currently find ourselves. And two factors in there: prices are up, so there's less fear, which is primarily in the puts. And it's been summer doldrums. There hasn't been a lot of activity. Some activity's picking up. It is the month of September, so you would expect some higher premiums. Keep that in mind. What this is primarily a point for is that you don't want to sell options naked in this type of environment. You could sell a put, sell a call, you might be right, but if volatility picks up, as one might expect, mean reversion to higher volatility, as you would see, this is an 1824 level of the index of premium on gold options volatility. What you see here is 20 to 22 is probably a more normal level. If you plot a moving average, let's see if it comes up. Yep, here we go. You would see the moving averages are higher. A 100-day moving average volatility says somewhere around this 21 level would be normal or relatively normal. So it is low. So the reason how we use this information is we choose a credit spread as the tool. Instead of shorting, let's say we were bullish or bearish, it doesn't matter. If we sold a put and the volatility increased, that could be a hindering factor of our profitability. If you use two options where you short a put or a call and then you buy one below it, you actually reduce the size of the trade, you reduce the risk, and you wash down the volatility factor to a degree. It's not completely washed out, but it actually minimizes it quite a bit, since you do have some long premium in there. So where does gold go? You might have an opinion. This isn't a video where we predict where gold goes. This is only where we cover some different strategies to take advantage of the gold market using option premium. Let's say we want to do a more conservative trade, an option trade, a nice bread and butter credit spread. Now there is risk. It is risky, so it's not a free lunch. But let's say we can get the direction right. If we think it goes up, we would sell some puts or buy some calls. If we want to be on the higher probability scale where we're predicting where it's not going to go, we'll have better odds versus trying to trade at the money, for example buying a 1250, 1300 and saying it goes up. So what we're going to say is, if we're bullish, we'll look for puts to sell in a put spread. We're going to risk the space between the two options. In this case is about $5,000. It's the max risk. In a short option you have unlimited risk. If you're just naked an option, we're not going to do that. We're going to have a fixed risk of the space between the two options. So what I did, I selected 3 options, each 50 points apart on the call side and the put side. I'll leave it up to you how risky you want to be, but this is how you would structure the trade. The closer you are to the at the money prices, the riskier the trade. You could have, actually, let me rephrase that. The closer you are, the bigger the delta. The risk may not be directly associated with the delta. If you want to, if you're just dead wrong, you're going to lose more money in that quote-unquote safer trade because it'll go completely against you, and you took in less credit. So don't get me wrong. It's the risk is associated with the delta, but the max risk is a $5,000 loss. Okay, so I hope that's clear. If you were expecting a sideways direction, up and down, not a lot of action, and not a complete sell-off, not a complete melt up, you could do a non-directional trade where instead of selling a call spread or choosing a put spread where you have to be right on the direction or it would help, you can do what's called an iron condor. An iron condor, you'd sell both sides. So you'd sell the calls in a call spread, you choose your risk. Maybe you do the 1450, 1400 for about roughly $400, and you try to match the same risk on the other side, and you're more non-directional. If you try to get 1400 on the call side, you'd want to get, 400 on the call side. You'd also want 400 on the put side. Okay, that credit offsets some of the risk on the top, and the credit from the calls offsets some of the risk of the put. Therefore, you get a better margin scenario. So we are covering a lot of information quite quickly, but if you miss something, you can always stop the video and go back and go over any of the brief topics we just mentioned. A put spread, we're looking for upside, we're selling the puts, and you get a good deal in commodity futures options for that risk, and you just want it to stay away from your range. On the call side, the same thing, you want it to stay away from your range. If it just goes sideways, you can be non-directional, sell both at the same time, and you'll get a deal on the margin. It may reduce the risk, but it's still not a free lunch. It could still go against you, and that's where you have to manage. It gets a little trickier. This video doesn't cover managing a trade once it goes against you, but in other videos we do cover how to manage a trade that's going against you. So I hope this helps. This is gold, wild market, it can be. So stay tuned for future updates. Take care.